Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It's a stellar day for stocks. Gains fueled by fresh earnings reports and new economic data. We saw some records at the end of the session. All major indices did end the day up. And companies are calling employees back into the office, but gender may play a role in who's heading it back and who benefits from that shift. We're taking a deep dive into a new labor survey. And precision photography is literally changing the game when it comes to making calls during sporting events. We're checking out this revolutionary technology and what it will mean for the future. Well, Netflix reporting second quarter earnings just moments ago. Those shares slipping a bit here in the after hours. And joining us for more analysis is Geetha Ranganathan, Senior Media Analyst at Bloomberg Intelligence. Geetha, it is good to see you. So Netflix reports, we know Q2, Geetha, tends to typically be a seasonally weaker period. The stock is down about 0.8% here in the after hours. But give us your take, Geetha. What'd you make of the print?
It was a really solid print, Josh. So, I mean, everything that we were hoping to see, Netflix definitely delivered in terms of their revenue growth for 2Q. They came in above guidance, above expectations. In terms of operating margin, again, outperforming expectations. The big thing I think that investors were really focused on was commentary for the rest of the year, and they delivered there as well. So they increased their outlook for revenue growth for the full year. It's up from 13% to 15%, which is pretty good. And then again, with operating margin also, they kind of raised that. But I think investors were looking for a little bit more here. So it was originally forecasted at 29% for the full year operating margin. They just took that up a smidge to 29.5. I think investors were looking somewhere in the range of 30 to 31%. So definitely solid, maybe not spectacular, and maybe that's why we're kind of seeing a little bit of this downward movement right now.
And how much, Geetha, do you think it could also be? I'm just looking at the initial reaction in the after hours. Just the run this stock had. I mean, what a move into the print, Geetha. It was up, I think 40% year to date?
Absolutely right, Josh. Up 40% year to date, trading at something like almost 50 times earnings. So in many ways, you would say that this was priced to perfection. And when you have a stock like that that's priced to perfection, obviously investors are thinking, what's next? And when you see a report that doesn't necessarily give you something screaming in terms of catalyst, I think that leads to a little bit of, maybe angst.
When you think about what's next, Geetha, let's talk about that content slate in the second half. I'm curious what you see there and what could that mean in terms of user engagement?
Yeah, user engagement is going to be super strong, Josh. There's absolutely no doubt about that. I mean, we've seen really strong results in the first half from a fairly decent content slate, but it's nowhere near what we're going to see in the second half. Remember, management themselves have called the second half slate an embarrassment of riches. They have some of their biggest shows coming on board. You have Wednesday, you have the last season of Stranger Things, which is going to be broken into two parts. You have an NFL game, you have boxing matches, you name it. You have Happy Gilmore, Knives Out, everything and anything. And if you kind of just look at Netflix's history in terms of a content release schedule, this is arguably their strongest 6-month period ever. So there is no doubt that subscriber growth is going to be extremely strong. And we've seen that momentum kind of building, and content absolutely is king, and it's going to be a key differentiator for Netflix through the rest of 2025.
And I know the Street, Geetha, also cares a lot about content spend here. What do those trends look like looking ahead?
Those trends actually look really, really strong as well. So remember, Netflix has guided already to spending only about $18 billion in content spend. That's a pretty modest increase. At the end of the day, Josh, what is happening in terms of content spend and in terms of the whole profitability equation is that you always want revenue growth to be higher than content spend growth. I mean, that's where the operating leverage in the model comes. And Netflix absolutely is demonstrating that. They are demonstrating sustained momentum in subscriber growth. They're demonstrating pricing power. And then, yes, you do have content expenses going up, but not by some crazy amount. They're taking a very disciplined approach to all pieces of content, including sports, which is really encouraging to see. So we know that margin is definitely on an upward trajectory here.
How is the competitive landscape evolving here, Geetha, for Netflix? I know in my house, the Lipton house, my 6-year-old, she's all about YouTube. So I'm just curious, how's the competitive environment? How is it evolving, Geetha, and Netflix's place in it?
Yeah, that's a really, really good point that you bring up, Josh, because, we've kind of seen Netflix dominate when it comes to streaming platforms. I think in many cases, many investors would say Netflix has already won the streaming wars. But then month after month, you look at the Nielsen Gauge report where they basically track viewing time by all of these different platforms. There is absolutely no doubt that Netflix is far ahead of its competitors. So they have about an 8 to 9% share of viewing time. That's far ahead of Disney, which is at 4%, Amazon Prime, which is at 3%. But then you just brought it up, right? The elephant in the room, YouTube. YouTube actually leads with almost a 12 to 13% share. And Netflix addresses this as well. Netflix knows that YouTube is its biggest competitor. And one thing that we are kind of worried about when we take a look at the longer term strategy for Netflix and for all of these streaming platforms is as we see more and more AI in content creation and content production, can YouTube, can a platform like that actually gain an edge? And I think Netflix is very aware of this as well, and they're going to kind of see how to beef up their content platform using some of the AI tools.
Final question, Geetha. You think about Netflix, you just think about how much data they have at their disposal. I'm just curious, do we know if and how, Geetha, Netflix is leveraging AI here?
Oh, they already, Josh, to that point, they just made a huge change in their content UI. They just revamped their whole user interface. And a lot of that is actually to feed the content recommendation engine, which we see. So, they've tested this. The way that they kind of frame it is, when 50% of the population kind of comes in, they know to watch Netflix, they kind of know, they have in mind already a title that they want to watch, but 50% actually don't. And that's where the content recommendation engine can play such an important role. And we've already seen kind of machine learning guide this. And now they're using AI even more to kind of refine those the algorithm, and they're making it much more intuitive and much more easy to use. And so I think we've seen Netflix kind of always lead the game when it comes to product innovation, and they're going to continue to do that. I mean, and AI is definitely going to help them.
Geetha, we are always so lucky to have you helping us break down these results. Thank you so much for joining us.
Thank you, Josh. Thanks a lot.
The S&P 500 and the NASDAQ notching a fresh record close. Investors digesting a wave of corporate earnings reports along with better than expected economic data. And Yahoo Finance's Jared Blickry joins us now with the trading day takeaways. Jared.
Thank you, Josh. We got to talk about those record highs here that you were just talking about, and I'm going to chart them for you. I'm going to start out with the S&P 500. This is a 2-month chart, and yes, each one of these candles is 1 day, and we just closed at a record high. Essentially, though, we are still at the top end of a 2-week range, so we haven't quite broken out of that yet. But if you look at the NASDAQ composite, we are definitely trending up as we have been since the lower edge of that chart 2 months ago began. And then you take a look at the Russell 2000. I like this too. Hasn't broken out, but we've seen some leadership over the last 2 days from the Russell, moving 1 percentage point, I believe, both days. Now, I did have some concerns about 30-year. We'll get into that in a minute, but let me just show you the VIX too. This is sitting near multi-month lows. We had a brief spike up yesterday that had to do with all that kerfuffle regarding Trump potentially firing Powell, but that was walked back. So things seem like they're getting back on track here with respect to the equities rally. I would like to see breadth improve here, but even meme stocks were up today for the most part. So I consider that kind of a win for the stock market.
Kerfuffle. Great word.
Oh, thank you.
Underused word. The 30-year yield, which you mentioned, and I know you've been focused on, what do you see?
Yields have been juicing commodities. Now, I'm going to dive into this on Monday morning in the AM hour, but basically my thesis is we have record fiscal deficits right now, and we also have the Federal Reserve on track to ease this year. The point is they're not going to be raising rates. So you have the Federal Reserve keeping rates low, you have all these deficits, and there has to be a relief valve. And usually that comes in the form of currencies or yields, in other words, the bond market. And so the currency market right now, the dollar is down on the year. However, it is being propped up a bit by tariffs. And so the relief valve has been in commodities. So, and I do want to tackle those yields here. The 30-year yield, you have seen that shoot higher basically, but there are some moves by Besant over in the Treasury that can keep that capped. So the release is commodities, and we've seen some super cycles in the past. You remember the 1970s, or maybe you read it about it in the history books, and also the early 2000s. And let me just show you what commodities have been doing recently. This is what happened today. You can see platinum up another 3.5%. But if I go to the last month alone, Check this out. Palladium up 24%, orange juice of all things up 18%, platinum 18%, copper. You got cattle in there. You got all kinds of things like sugar. So we're seeing a lot of pressure on commodities, and that is where all this fiscal, these deficits is being expressed. So I'm going to tackle that Monday morning, give you some more details there, but that's the short and long of it.
Switching gears, we talked to a congressman on the show today about the crypto bills on Capitol Hill. So let's do a quick check on crypto.
You
perhaps?
bet. Ethereum has been mooning recently, and there's been a lot of excitement about this. I'm going to chart a bunch of these guys. Let's get my crypto heat map up there, and you can see this is over the last month. And let's just stick with this for one hot second. You can see a lot of outsized performance here. XLM, Automatic up 85%. There's Algo up 76%. Ripple up 55%. Here's Ethereum 36%. And this is the intraday chart of Ethereum. Let me go to let's do year to date right there. And you can see it's just shot up. And most of it is just due to recent price action. We've seen huge inflows into ETFs that cover the Ethereum market. And so that has been beneficial for this. All in all, I see a lot of potential with the crypto space here, especially with this institutionalization of it. These things have to go to the Senate, and so there's more work to be done there. Anything can happen, but things are moving in the right direction for crypto, especially with all this breadth, which I've been telling you I really like.
Quickly, on deck tomorrow, what's on your radar?
Options expiration, always a fan favorite, right?
Thank you, Jared. Appreciate it, my friend. The recently passed One Big Beautiful Bill Act contains a provision that could fundamentally destroy professional gambling in the United States and drive millions of bettors to unregulated offshore markets. Joe Pompliano, host of the Yahoo Finance Sports Report, join me now. Joe, my friend, always good to see you. On your Substack, my friend, you write about what you call here, this is the new law, you say, that could kill legal sports betting in America. And you're referring here to a provision in the Big Beautiful Bill. Walk us through it, Joe.
Yeah, thanks for having me, Josh. So this is actually a much bigger deal than I think many people realize. You'll look at it and you'll say, okay, what does professional gambling matter to the average individual? But it actually matters a lot to anyone who's placing sports bets or anything else like that. And the way it works now under current tax law, professional gamblers can offset 100% of their losses against their winnings. That means someone who wins $100,000 in a year and loses $100,000 in the same year pays no taxes on their gambling activity. That makes sense. But under this new provision in this bill, those losses are now capped at 90%. So if we use that same example at $100,000 in losses and $100,000 in winnings, rather than paying no taxes, you're going to be faced with a $10,000 tax bill on what effectively was no profit, right? So the way to think about this is that this really hurts sharps or professional gamblers. And if those people leave and go offshore, it has this downstream effect on everyone else because those bettors are used to place odds. They fund a lot of the prize pools that are being used in daily fantasy sports. And overall, it creates a much less efficient market. Now, the one caveat to this is that I think a lot of the sports books are actually okay with this and probably even push for this because they don't want these winning bettors participating at their books. They want the retail bettors who on average lose a lot more than the professional gambler. But I think people are underestimating the long-term impact that this could have on the average bettor as well.
Who would potentially win from this legislation, Joe? Who could stand to benefit?
Yeah, so the federal government would benefit, I guess, in some sense because they would be able to collect more tax revenue, but you're essentially shifting that revenue from the states to the federal government. So the states would be the losers, the federal government would be the winners. Again, I also think that the sports books probably benefit in some sense, although if you look at it and you hear the demise of gambling in the United States, they would be losers. But at the end of the day, if retail continues to bet, the markets become a little bit less efficient, they're going to be okay. What the benefit is to them is that these professional gamblers would no longer be placing bets at their books, which in turn is great for them because those are the bettors that are winning all the time, right? So if you're eliminating the winning bettors, you're stuck with a bunch of bettors, retail bettors, that traditionally lose at a much higher clip than professional bettors. That is ultimately great for sports books.
Also, Joe, switching gears here, you report and write about Hawkeye, which you call one of the most important tech innovations in sports history. Big claim, Joe. Let's start with the basics. Explain for the viewers here, what is it? How does it work? Why is it so important?
Yeah, Hawkeye is a very important piece of technology that every sports fan has interacted with at some point, even if they didn't know it. So the most obvious example is during a tennis match when one of the calls gets reviewed, you see the animation come across the screen and it shows the ball hitting the court in the shadow to determine if that ball was in or out. Now, this technology has now been applied across virtually every sport after that. It was initially found in 2001 for cricket. It went into tennis in 2004. It's now eliminated line judges at basically every major tournament at the Grand Slams, Wimbledon, the US Open, etc. But now a bunch of other sports leagues are finding ways to use it too. So FIFA is another great example. They use Hawkeye technology to review goals, penalties, red cards, offside decisions. MLB used it in their All-Star game the other night to challenge balls and strikes that were called by the umpire. And the NFL is going to be the next big one using it when they implement it this upcoming season to measure first downs virtually rather than using the chain gang, which was more than 100 years old.
And Joe, who owns Hawkeye and how does it make money?
Yeah, so Sony owns Hawkeye. They bought it about a decade ago for $32 million. It's a much bigger business now. They have hundreds of employees, and it's quite a big business. I mean, the installation alone is expensive. If you think about a tennis court, it costs about $100,000 to install Hawkeye on a tennis court. That's why only the major tennis tournaments are using it, not all the smaller ones. But then they make a bunch of money off other revenue streams too. If you think about maintenance, licensing fees, using the actual equipment and providing you with the analysis, there's performance and analytics that they're delivering to the leagues off of this too. So they've developed really 4, 5, 6 different revenue streams off of the equipment itself, which has become really beneficial. Now, we don't know the revenue numbers and things like that, but Sony has dedicated a lot of resources to this. And there's a reason why they paid $32 million. And now, I mean, when they bought this business, it was really just in tennis, cricket, and some other secondary sports. But now they have the NBA, NFL, MLB, FIFA, et cetera. So these companies are paying and these leagues are paying a lot of money. I mean, even just in FIFA, it costs $250,000 to install this system. We're talking about 6 to 12 cameras, depending on the stadium, inside the stadium. Then we're talking about licensing fees, monthly maintenance fees, and everything on top of that. So you can quickly see how this can become a pretty big business for Sony too.
Joe, always great to have you on the show. Thank you, sir.
Thanks, Josh.
Well, the return to office is in full swing, but men are returning in greater numbers than women. For more, we're bringing in Yahoo Finance senior columnist Kerry Hannon. Kerry, fill us in.
Yeah, this is the Department of Labor came out with some new numbers recently showing that, while the numbers I think were 29% of men are now working from home, and that's down from, it was 34% 2 years ago. So we're seeing that shift to men going back to work, and 36% of women are still working from home, and that's pretty consistent. And so what's interesting here is, and kind of somewhat alarming for women, is that a study I saw recently showed that 9 in 10 CEOs say that they value people who come into the office for raises and promotions, and they're more likely to reward them for coming in the office. So for women, could this really, even hurt the pay gap even more, because women currently, Pew Research says they make about 85% of a male's wages. So if this could be yet another thing dinging women's wages and promotions abilities. But let me back up just 1 second and explain the reason perhaps one of these that men are skewed more to getting back to the office is that a lot of these industries calling people back to work are tech industries, computer industries. Technically, these are often considered male-dominated industries. And so we may be seeing that shift in numbers because we have the companies like Google and Meta and Amazon saying, hey, get back to the office. And a lot of these are men who have these computer jobs, programmers, that kind of thing. So I think that's sort of the shift we're seeing. But the really good news that is, Shrim came out with their report this week showing that, flexible work really is now stabilized. And across the country, employers have gotten the fact that hybrid work, actually flexibility is a good thing. So we may see there's not hard line drawn between in the office or at home, but hybrid is going to take an even greater role. And I think women can embrace that.
Kerry, always good to see you. Thank you.
Thank you.
Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.